Watching What's Hot on CNBC TV 18, and here's an exclusive. Even though the January IIP numbers indicated that the economy is still reeling under the impact of unprecedented global slowdown, KV Kamath of ICICI Bank feels that the situation will definitely improve this quarter itself. Vivek Law caught up with the head honchos of ICICI Bank, both KV Kamath and Chanda Kochhar, and began by asking them if they detected any sign of a turnaround in the economy.
We had a CII National Council meeting just about 2 weeks back in Delhi, and we had about 75 or 80 members present, council members present there. So I asked a very simple question, constructed as follows. Is the current quarter going to be worse than the previous quarter? Show of hands. Is this worse than the previous quarter? And out of 75 or 80 members, one hand went up. And that was from a member who comes from the textile business. So to me, this is a dipstick.
Is credit offtake any more an issue, owing to the liquidity side of it at least?
No, in
or
fact,
that is not a problem anymore?
Liquidity is not a problem at all. After all the monetary policy measures that have been taken by the RBI and the government, I think liquidity in the system is very, very comfortable.
Are fear of defaults keeping you more cautious than you were perhaps 3 quarters or a year ago?
What is keeping us more cautious is the need to more proactively monitor where each company is. So I think that is what a banker needs to do currently. It's important for us as bankers today to understand where, in terms of working capital cycle, in terms of capacity utilizations, in terms of profitability levels each company is, and work out a solution that will help the company tide over the current situation. And therefore, in fact, at a situation like this, we should never allow the company to reach a default stage. What we have to do proactively is sit with the company and say what is the right solution.
But are you seeing rising defaults, at least in the retail credit side?
No, retail credit side, in fact, mortgages continues to perform as it always has been. Default levels are very, very low. The car finance, again, continues to perform always as what it always has been. So there has been no increase in defaults. On the unsecured loans, the very high-priced unsecured loans or credit card dues, definitely loss levels have gone up for the industry as a whole.
But there still seems to be a fairly wide gap, isn't it, in your cost of borrowing and what you're actually being able to pass on. So do you think that there is scope for further rate cuts in the coming weeks and months, as far as you as a bank is concerned?
See, if you look at the trend in the inflation, and the rate at which it's going down, and, very soon if it becomes negative, I think the general interest rate scenario has to only look downwards. To some extent, corrections have happened in the lending rates. To some extent, corrections have happened in the deposit rates. Of course, not to the extent that actually some economic factors like inflation demand. But on the other hand, we have certain other factors like the bond yields, which have moved the other way around. So I think we are still finding a place where all these things would adjust. But yes, if you ask me directionally, would interest rates correct further? I would think they should.
You've always been more bullish than the rest as far as India's economic story goes. You're still convinced we'll end this year at 7%? And what's your forecast for FY10?
I think I'm absolutely convinced that we will come in at 7 plus or minus a wee bit, probably plus. As far as next year is concerned, if indeed I believe the dipstick that this quarter is going to be better than last quarter, the whole of next year should look better than the whole of last year. So 7 to 8%, possibly 8% is my number for the coming year. Beyond that, my aspiration would be to see India getting into double digit, but that's a bit too far off into the future. But I think 09-010 is going to be around 8%.
Last question, Mr. Kamath. Do you still see the need for some more stimulus coming from the government, or do you think that these 2 packages that we've seen, or 3 rather, that we've seen, are enough for the time being?
I think more than stimulus, what I'd like to see at this point in time, wearing that industry hat, is try to have interest rate stability. Because we are finding a curious situation where deposit rates are dropping, inflation is dropping, where there is a fairly largish government borrowing program, but the bond rates are spiking up, completely, I would say out of context with these 2 rates. So I think that there has to be some clarity on this, and we need to settle down to a level where banks can then take a call